Transactions not regarded as transfer. Conversion of a sole proprietor stroke firm into a company. So first let us understand this and then we will see the legal point. Let's say there is a sole proprietor or there is a partnership firm. Okay. When people start business, they start small, right? Their liabilities and everything is also limited. But we know that in a partnership firm and a sole proprietorship firm, the liability of the proprietor is unlimited, right? So as the business grow, they decide, let us form a company, okay? But forming a new company and starting business altogether is not a feasible option. So what these people do is, they convert the sole proprietorship or a partnership firm into a company. Okay, and by doing so, there is a transfer of all the assets and liabilities which are owned by assets plus liabilities, which are owned by the sole proprietorship or the partnership firm to the company. The question which comes up is that in such a conversion, should capital gains tax be levied? If you see in real terms, what is happening is that just the business is being transferred. There is no gain which is derived by either the sole proprietor or the partnership firm. And therefore, the law also provides that such a transfer, such a conversion will not be liable to capital gains tax. So they have excluded it from the definition of transfer. But there are certain conditions which are attached to it to ensure that the benefit is available only to genuine cases. Let's see this. In case of succession of a sole proprietor by a company, which means what? The business of the sole proprietorship registers itself as a company in the business carried on by it. So this term is important because there has to be a business which the sole proprietor was carrying on, which will now be carried over by the company. So there is a succession of the business. Transfer of capital assets or intangible assets to the company shall not be regarded as a transfer, provided these conditions are satisfied, which is all assets and liabilities of sole proprietor concern relating to the business become assets and liabilities of the company. So whatever assets were there with the sole proprietor, you transfer it. So you transfer a business. It should not be that, you are just transferring some plant and machinery and all. Just to avoid capital gains tax, you say, oh no, this is a succession case, right? The second thing is shareholding of the sole proprietor or the owner of business in company is not less than 50% of total voting power. So both in terms of economic ownership and the voting power, it has to be 50% for 5 years from succession date. So whenever the succession happens, from that date, for continuous 5 years, you should continue to own at least 50%. If you don't own, then the benefit is withdrawn. And the third condition is sole proprietor's consideration is only share allotment in the company. You can't take cash or any other benefit directly or indirectly from the company. What you are supposed to receive is only the shares in that company, right? If these conditions are satisfied, then the succession of the sole proprietor business with that of a company will not be liable to capital gains tax. Similar to this is the case of succession of a firm by a company, okay, in respect of business carried on by it, okay. In those cases, transfer of capital assets or intangible assets by the firm to the company is not liable to tax, provided again these 4 conditions are satisfied. These 4 conditions are same as this one. The only difference is here you had a sole proprietor. In this case, you will have partners. So let's read through these 4 points. All assets and liabilities of the firm relating to the business become the assets and liabilities of the company. Partners before succession become shareholders in the company in proportion to capital accounts before succession. So if there were 3 partners, A, B and C, and they had 20,000, 40,000 and 60,000 worth of share capital before conversion or before succession, then whatever is their shareholding in the company should be in the ratio of 20,000 is to 40,000 is to 60,000, right? The third thing is shareholding of partners in companies not less than 50% of the total voting power for 5 years. So the total shareholding of these three people has to be 50% for 5 years. And partners' consideration is only share allotment in the company. Again, simple, right?